Today, we're taking you inside one of RealWealth's newest offerings, our second Texas fund. This is a strategic value add fund targeting single family and multifamily rental properties. I'm Kathy Fettke, and welcome to the RealWealth Show.
You're listening to The RealWealth Show with Kathy Fettke, the real estate investor's resource.
To help us walk through how the fund works, why we built it, and who it's right for, I'm joined by my partner, Leah. She's here to break down the strategy, the markets, the returns, and everything investors need to know before jumping in. And if you want to learn more about it, just go to realwealth.com/fund. That's realwealth.com/fund. All right, well, let's get on with it. Leah, welcome back to the Real Wealth Show.
Thanks so much for having me.
I'm excited to talk about our second fund because the first one is still going, but it's not open to investors anymore, but people ask about it. So we started a second one. Let's just start with what is the difference between our new fund versus the older one?
Yeah, so I think first difference is it's available.
Right.
We're in a little bit different time than we were then. So when we just started the first fund, we focused a lot on renovations, deep renovations for a lot of equity capture and a lot of older properties. And with this newer fund, we're focusing on a lot of these high growth areas and new neighborhoods, new properties, but still below market value. So very excited to have a little bit of diversity to fund operations and excited to get this one smooth and running really kind of full capacity very quickly.
Why do you, I know you talk to investors all the time, I do too. Why do you think some choose syndications or funds like this one versus just buying for themselves?
You know what's funny is a lot of my clients do both. I think there's
Mm.
pros and cons to each option. The great thing about a fund is you don't have to do anything. You're putting in money and you're just sitting back and receiving distributions. And the great thing about a single family fund, which is very uncommon, is you get all the benefits of that kind of diversity and lower risk profile of single family while still getting the benefits of a syndication like you generally see with multifamily or commercial. As most of you know, if you've heard me chat, and Kathy, you and I talk about this a lot, I'm very, very much a proponent of single family and, 1 to 4 family property. There's a lot more ways to exit. There's a lot more ways to diversify and to sell. And it's just a very different type of model. And so for me, it makes a lot of sense that we can offer a passive way for people to do that and get those benefits. But a lot of people, they love having active ownership. They love having single family that they can do and 1031 and all of that. And so, it's not one or the other. I think really a lot of people do both, but there's pros and cons each way.
Yeah, that's important to notice is that you can't 1031 exchange into a fund. The property that you 1031 exchange into has to have the same titling, and so that's just impossible with a fund. It might not be impossible. I know there's ways to do it, but it could be complicated. So we're not in this fund. But some people, I know a lot of our members are, I don't want to say aging, but I'll just say aging. And they just don't want to, they want to be sailing or, doing the thing that they would love to do in retirement. And a fund allows that because we do the work and they just invest. So it's very different that way.
Yeah, and it's still a long-term investment. It's something that you can count on for many, many years. And for a lot of people, that's what they're looking for. And, having 6, 7 years of ownership without having to worry about making decisions and doing refinances and all those things that come with active ownership is really one of the main benefits of a fund.
So in the first fund, we were buying more distressed properties, would you say? It was taking a little bit longer to renovate,
Mhm.
but also the deals were phenomenal.
Yeah.
I mean, oh my
Yeah.
gosh. Yeah, but that was right when Jerome Powell had announced that he was going to raise rates. He had said there would be pain in real estate. So it was almost like we were the only game in town. I know in some cases you had wholesalers calling you, begging you to buy the property. And so the discounts were heavy. That was an incredible opportunity. But what's the landscape now for buyers?
Mhm. Well, what I'll tell you is when we did the first fund, we were doing a mix internally myself. So I've got a $45 million portfolio, as you know, and we were doing a mix of renovation properties and new properties. And the great thing about those renovation properties is we had a lot of equity that we were able to gain. The unique thing about right now is there's a lot of builders that are trying to liquidate inventory. It's not that it's not selling, but one of the problems they're facing is that their build lines got cut. So they can't build as much at once. And so what we can do is we can swoop in and we can do these packages and we can can get in and buy things that are finishing right now that they've got to get off their books so that they can start their next batch that the bank won't let them do otherwise. Because one thing that has changed from 4 years ago to now is that lending is tighter for these builders. And so one of the great things that we have the opportunity for is to get these new construction single family homes for 180, 185, $190,000, where these are homes that traditionally we'd be selling for 220, 230, 240. So there's a lot of great opportunity. If this had existed 4 years ago, we would have done some of this then, but it
Mhm.
didn't. And that is because of the climate after rates went up. And this is really a short-term benefit we're going to have right now. This isn't going to be around for long. The statistics coming out for next year of what they're polling is 88% of home buyers on the sidelines are going to be buying next year. So we're going to be in a very different boat, I think, in a year. There's no crystal ball, but that's what I'm banking on. So it's
Yeah.
a great opportunity, just like we had 4 years ago, different opportunity. But I think in the end, we're going to have a fantastic return. And, one of the things we were able to do with the last fund was go refinance after we stabilized and then do this cash out to go buy more property and returned a distribution to our investors, a large distribution. And this new fund is going to do the same thing. As we stabilize, we'll go do that cash out refinance, go buy more. And the more we buy, the better the return gets. And so it's similar in a lot of ways. It's the stabilization time that's a lot faster.
Yeah, it's funny. We went to the investors and had them vote. Do you want all of the money from the refinance? Do you want all your cash back, or do you want just some of it and we'll go buy more? And it was unanimously, yeah, go buy more. We'll take the
Yeah.
money later. Okay, how about the territory? How does this fund different than where we were buying in the last fund?
Yeah, so we focused on the last fund, all of these areas that are the highest growth regions, especially our tech corridor, right outside and inside the kind of outer skirts of Collin County. That's where I live. So Collin County is getting 50% of the growth for North Texas. So North Texas is consistently the fastest growing job market in Metro, number one and two. And so what we see is a lot of growth in this Collin County area. And that's really, it's just an incredible thing to watch, right? So we've got about 1.5 million people moving here in the next few years, and half of that's going to Collin County, right in my backyard. The great thing about this fund is because we're focusing on some of these new construction neighborhoods, we're actually able to get into Collin County. The last fund, I was only able to get a few. This one, we're going to be able to get a lot. And then focusing heavy on Grayson County, which is the new chip manufacturing corridor, kind of capital of the United States. It's got $50 billion in investments going into an area of about 50,000 people. So it's just
Wow.
incredible what's happening. So I would say most of the area is very similar. A lot of these houses that we're looking at right now for the new fund are right down the street from the ones we did before. So the model that we've been following for the last 20 years has not changed, right? We want to be on the outskirts of the main city and these lower crime, high growth areas that are really affordable, but experiencing that boom in population and job growth. So the model hasn't changed. What's changed is the product type we're looking at.
It's so interesting because headlines are often so different than reality, and that's why at Real Wealth we're always listening to the boots on the street versus what we hear on the headlines. The headlines are saying that, every prices are down and rents are down in Dallas. What are you experiencing?
Yeah, so I mean, I think it's for me, what's happening right now is buyers can't afford to buy. And those that can afford, they're waiting because rates are coming down. And so will I say that there's as many buyers and this massive 20, 30% growth a year that we were seeing 7 years ago? No, but I wouldn't expect that, right? I don't think that 20 or 30% is sustainable. As much as I love that as an investor, if we were having that every year, we'd have a really big problem. What we want is steady growth. We want consistent growth, and we want to buy in these areas that are just kind of the sleeping dog lying in wait. We all know rates are coming down, right? Powell's going to be out of office in just a few months. Trump's already naming replacements. He has been very clear about where interest rates are going to go. And I think even all of your top economists are saying property values are going up next year. So the question is, do we take advantage now while we've got this opportunity where fewer buyers are in the pool, or do we wait? And we've never been ones to wait, right? We want to capitalize on what's going on. Same thing we did back in COVID, same thing we're doing now. So I'm banking on high growth and I'm banking on rents rising, but I'm not going to wait for that to happen because that's not the time to pounce. The time to pounce is right now.
And you generally like single family, but we're going to have some multifamily in this fund. Uh, Texans generally like to have their space. So why multifamily in this fund?
So, multifamily is an interesting thing. Anything 4 units and above, or 5 units and above, rather, is considered multifamily. For us, what we're
Mhm.
looking for are where we can get a lot of bang for our buck, but we can still treat it like single family. So, when we look at 4 units and 8 units, they're areas that are kind of designed like townhome communities where each tenant's responsible for their own utilities, their own yard care, their own pest control. So, we get the feel and the benefit of single family without the risks of multifamily. The problem with multifamily is values derived from income, and the types of financing and exit strategies are very different. And that's why you see the volatility. We don't have that in single family. So, as long as we can structure it to feel and look like single family, that's exactly what we're going to do. I myself buy dozens of units every year that are these 4 to 8 unit properties. So, it feels like single family, but it's technically multifamily. But when we go to exit, it exits just like single family. And that's what we're looking for easy exit and top dollar.
And let's talk about how the money flows. First and foremost, investors receive 100% return of capital before the managers participate in profits. Why? I'll just throw it to you. Why did we structure it that way?
Well, I think it's really the best of both worlds for everybody, right? We want the investors to invest with us. We love what the model represents and what the fund represents, but we want them to be paid back before we're getting paid. And I think for you and I, that's both a really important thing because it speaks to who we are and our integrity and also what we're looking for, which is providing returns to our investors. And so, paying back that capital is a wonderful thing to do first before we get anything. And of course, when we go to do that refinance, that's going to take a big chunk out of that too. So it's the right way to do it.
I agree. And the profit split 75% to investors, 25% to managers once the capital's been returned. So people are going to always should ask, what are the risks? So I will throw that out to you. What are the risks in this fund?
Yeah, so what I would say is we do our best to diversify within a very large market. DFW is the fourth largest market in the US, soon to be third. The main real risk is that you're investing in one metro. Now, are we all in one neighborhood, all in one city? Are the properties an hour from each other? Absolutely. Like we're doing the best we can to diversify within the metro. And my portfolio is 99% in the metro too, but that is a risk. You're investing in one metro. What I would say though is we're arguably one of the strongest and most insulated markets. So if we're really falling apart, we have much bigger things to worry about than what you've invested in the fund.
What about property taxes? We keep hearing that they will be better. What's
Oh,
the,
yeah.
yeah.
Yeah, so our governor's been on record for really a very long time about disbanding property taxes. And so they did rate compression on the school tax rates, which brought down school tax rates. They've increased homestead exemptions and exemptions for investors. So a lot of what's happening right now in property tax incentives is happening for investors and homeowners that live in their property like a homestead. This year, what he's going into for the next season is he wants to get rid of school taxes completely. So that is his next step in the plan. And that is one of the largest parts of a property tax bill. There's a lot of ways that they're coming up with that they're going to get rid of property taxes completely. The largest of which is a consumption tax, which would mean if you spend money here, your sales tax is going to be higher. But I think that's a longer term plan. Governor Abbott is running for reelection. I absolutely believe he's going to win. I was actually at an event with Pat Fallon, one of our congressmen, last night, and they were talking about this exact issue. And I think everyone is in agreement that our massive surplus and the amount of money the state is bringing in needs to bring down property taxes. And a lot of our areas here have been very stable with their property tax rates and even reducing them. So I think that that's a big part of what's to come. I can
Mhm.
tell you at the county levels, as I shared with you last night, Kathy, Michael just won his race for county commissioner here in Collin
Yeah,
County.
congratulations.
Yeah, thank you. One of the big things that he ran on was reducing property taxes because a lot of these areas, the growth, the price growth, the tax growth, they're bringing in more money than ever before. And if we can properly manage the budget, not only at a state level, but the local level, and go into these base budgets, which are just kind of the amount of the budget that's never looked at, there's a lot of savings to be had there too. So you've got surplus, you've got a lot of things that can be cut cost on. So I absolutely foresee that we're going to have significant property tax reductions this next go around. But that being said, we don't have a state income tax. And so our property taxes, people talk about how high they are, but in reality, in retrospect, they're really not. And so I think that we're going to see a lot of positive trajectory over the next 5 to 10 years. And certainly Abbott, and then where we were last night with someone who is intending to take over from Abbott when he's done and running for that position. They're all in the same boat. Property taxes need to come down with the surplus. And there's a large surplus right now.
Wow. Very different than California.
Yes.
All right. And finally, insurance. Are you seeing insurance costs rise the way we are and many states are today?
We've been pretty stable the last few years. There was a jump after COVID. And, in North Texas, we don't really have a lot of the risk factors that you have in other areas. So, like, I own properties in Florida and I've seen a significant increase there from storms, although this year was quiet, knock on wood. We haven't really seen a lot of that. I would say from 7 years ago to 4 years ago, there's been a jump, but really the last couple of years, things are pretty consistent. What we have seen are some insurers leave the market, but they are leaving the market not because of anything to do specifically with the market, but it's just leaving that space. So in
Mhm.
North Texas, we don't get hurricanes, we don't get, bad earthquakes. A lot of the stuff that you guys deal with on the coast and they deal with in Florida and New York, we just don't get that stuff.
Yeah, keeps the insurance costs down. I hope it stays that way. All right, Leah. Well, thank you so much for joining me here on the Real Wealth Show, and thank you for serving so many of our Real Wealth members for so many years.
Thank you.
And thank you for joining me here on the Real Wealth Show. If you want to learn more about how to acquire properties in Texas or other hot markets, just go to realwealth.com. I'm Kathy Fettke. Thank you for joining me here on the Real Wealth Show, and we will see you on the next episode.
The views and opinions expressed in this podcast are provided for informational purposes only and should not be construed as an offer to buy or sell any securities or to make or consider any investment or course of action. For more information, go to realwealthshow.com.